If you leave your cash sitting in a savings account, it is slowly being destroyed. In an era of unpredictable monetary policy and aggressive money printing, inflation is actively eroding your purchasing power. To protect what you earn, you need a concrete physical asset that outpaces that erosion. This timeline graphic shows exactly what we are going to build today. We are going to walk through the exact mathematical sequence required to take a one-time $30,000 investment and transform it into nearly $1 million in debt-free wealth over the next 30 years. This entire system relies on a straightforward three-part operational loop. First, you acquire and rent out the property. Second, the tenant pays you enough rent to cover your mortgage, property taxes, and insurance. Third, while the tenant pays down your debt, the physical property continues to appreciate in value. You are setting up a self-funding machine. You acquire an asset, you force someone else to pay off your debt, and your net worth quietly compounds year after year. To understand why real estate works, we have to test our alternative. This split-screen chart illustrates what happens if you drop that same $30,000 into the stock market. If we assume a generous 10% annual return over 30 years, and we assume you pay zero taxes on the gains, your initial capital grows to over $500,000. Now look at the right side of the screen. In real estate, you do not buy a $30,000 asset. You use your $30,000 as a down payment to control a $300,000 property. This is where the math accelerates. When the property goes up in value by a historically conservative 4% a year, it is not your $30,000 down payment that is growing, it is the entire $300,000 asset. Over 30 years, that 4% compounding growth on the larger asset pushes your total value to $973,000, completely dwarfing the optimistic stock market returns. Let's test this concept. Imagine you use $40,000 in cash to buy a $400,000 house. In year one, the market appreciates by a modest 3%. What is your actual return on investment? The answer is 30%. A 3% gain on a $400,000 property equals $12,000 in new equity. Since you only put $40,000 of your own cash into the deal, that $12,000 gain represents a massive 30% cash-on-cash return in a single year. Understanding the mechanics of leverage is the precise dividing line between average index fund contributors and wealthy real estate investors. You are using a small fraction of your own money to capture the growth of a massive asset. To make this system function safely, you have to buy right. This spreadsheet demonstrates the strict mathematical definition of a good deal. You must check local comps and ensure the monthly rent you collect exceeds your mortgage payment, your property taxes, your insurance, and your maintenance costs. If the final number is not green, you do not buy. Once you have positive cash flow, you have to protect it from bad tenants. Late payments and property damage will destroy your margins. You must run a full credit check and a thorough background check to filter out red flags before anyone signs a lease. You also have to legally insulate your personal savings. If a freak accident happens on the property and you are operating under your personal name, your own home, stocks, and savings are at risk. You must deed the property to a limited liability company and carry a dedicated landlord insurance policy to create an impenetrable legal firewall. You also need to navigate local operating laws carefully, particularly around security deposits. Some cities mandate that deposits sit in separate interest-bearing accounts, and minor clerical errors can trigger massive lawsuits. To avoid this legal trap, many landlords simply charge a non-refundable move-in fee instead. Running a perfect financial model on a spreadsheet means nothing if your physical asset and your personal wealth are left exposed to liabilities. Execution requires total legal protection. The final advantage of real estate lies within the U.S. tax code. There is a specific deduction known as depreciation. The IRS allows you to claim that your rental property is losing value over time, giving you a substantial paper deduction on your tax return. This flowchart tracks how that deduction works in practice. Even though your property is actually increasing in value and you are collecting monthly rent, you apply the depreciation deduction against your revenue. In most cases, this perfectly offsets your rental income, meaning you pocket the cash flow without increasing your tax bill. When you decide to sell, you can utilize a 1031 like-kind exchange. Instead of cashing out and paying capital gains taxes, you take the profits from your rental property and immediately use them to buy a larger rental property. You roll your wealth forward, legally bypassing the tax collector entirely. When you hold these properties until the end of your life, the tax advantages finalize with the death tax exemption. Your heirs will receive the real estate with the tax basis reset to the current market value. As long as your total assets are under $13 million, or $26 million if you're married, your family will inherit the entire portfolio completely tax-free. Once you understand the mechanics of depreciation and exchanges, you realize real estate is a legally sanctioned, government-subsidized system for generational wealth preservation. Let's consolidate this into your execution checklist. Build an excellent credit score to secure a low interest rate. Run the exact cash flow math before you buy. Deed the property to an LLC. Screen your tenants aggressively. Take rapid legal action on unpaid rent. And utilize depreciation to shield your cash flow. Managing physical properties absolutely takes effort. There will be unexpected repairs and administrative headaches. But applying this strict mathematical blueprint is a time-tested, highly reliable path to securing your financial independence in the United States. Taking disciplined action on your first property unlocks a lifetime of financial security. If you found this breakdown helpful, please like, share, and subscribe to USFINOX for more step-by-step financial blueprints.